This is Blane Markham, the Chief Trading Strategist here at the Markham Trading team. Thank you so much for tuning into my market update for this week. There's certainly a lot of interesting price action going on across the board, so let's go ahead and hop into it here with our chart. So here I have a chart pulled up of the S&P 500 headline index right here. And you can see we're continuing to get much of the same from the S&P 500 index. Over the past several months, this index has been largely range bound, stuck trading between, roughly 6,800 on the lower end and about 7,000 on the top end. As I mentioned here recently, there's been several occasions where we've traded up to 7,000 and failed. We've done it about 3 or 4 times here just in the past couple months. You can see just early last week was the last time we tried to go up and trade up against 7,000. There's a very clear ceiling of resistance at that level, 7,000 for the market at the S&P. That's very clear by looking at this chart. But also, too, on the bottom end right now, at least for the headline index right now, we're continuing to hold pretty firmly above this level of 6,800 as a floor of support below the market. You can see that as we've traded down to this level on 3 separate occasions now, here in mid-January, here in early February, and now here again this week to begin this week's trading. We've traded down to 6,800. We haven't closed notably below it. Had too much confirmation below that level of support at this point in time, but certainly we're starting to see some signs that we could be in for a short-term trend reversal here for the market. And what is telling me in the chart that we could possibly be in for a bit of a pullback here potentially in the weeks ahead is that we're starting to get some further confirmation now that we've broken down below the 50-day moving average. Again, you can see that we did close below the 50-day here. We closed below the 50-day here earlier this month. And then we did it again actually just this past week on Thursday and then on Friday. But you can see here again in today's session on Tuesday, as we open up the markets, we've yet again closed below the 50-day moving average for the 3rd consecutive trading session in a row. This is not something that we have done on the S&P 500, actually dating back until November of last year when we had a pretty substantial pullback throughout the middle of November. So this is notable, seeing that we've actually gotten some confirmation closing below the 50-day moving average that we could be in for a bit larger pullback. So we kind of have a few different competing narratives that are somewhat in tension right now. We still do have an S&P 500 index that isn't an overall confirmed uptrend because it's trading above its 200-day moving average. It's only, just a few percentage points off of its all-time highs, but it's starting to show some signs of wobbling when you look a little bit deeper into the charts, particularly because of the things I just pointed out to you. So we're still seeing 6,800 hold pretty solidly as support at this point in time. We could certainly see that begin to break down throughout this week's trading. We certainly could see that breakdown throughout this week's trading. I mean, it's impossible to say exactly where the index will end up by the end of this week. But, we are seeing those shorter term signs that we could be beginning to see a series of lower lows and lower highs beginning to develop after these 3 consecutive closes below the 50-day moving average. So all in all, the key takeaway here is that the S&P headline index is truly at a really key inflection and pivot point right here because there's a clear line in the sand drawn at 6,800. And I think if we see the market break down below that level and provide some further confirmation of the breakdown, I think we could potentially be looking at a larger correction on our hands. Now, of course, some of the other charts out there in the markets, if you're looking at the Dow Jones index, that looks a lot more constructive. Even the small cap index looks quite well, or even the S&P 500 equally weighted index. All of these are continuing to perform quite well because, of course, a lot of this selling pressure that's weighing on markets right now is really concentrated very highly into the tech space, into the momentum trade, the really unprofitable, high-flying momentum names. And so, while some of those other indexes, are continuing to look very constructive and look quite strong, a number of the S&P names under the surface are continuing to rise. It's still because the weighting of some of those mega cap tech stocks is really starting to weigh on the performance of the headline index, and even more so on the tech-heavy NASDAQ indexes too. This is the NASDAQ composite. The NASDAQ 100 chart looks very similar, but you can see a very clear pattern of lower lows and lower highs. You can see this really started ever since the end of January here, where the index topped out. It was trying to get back up to its prior high right around 2,400, and then it ultimately got back into this decline here that we've experienced over the past couple of weeks, where we've seen it fall below its 50-day moving average. And that actually happened on the first trading day of February, and it has not popped back above it ever since. It's tried to, but the index continues to fail every time it tries to get a rally together. So you can see this extended series of lower lows and lower highs that has begun to develop. And now it looks like the NASDAQ could be starting to contend with its rising 200-day moving average over the next couple weeks. If we continue to see the NASDAQ sell off at this current pace that it's at right now, we do have a very key level of support dating back to the November sell-off of last year that comes in right around 2,200 on the index. And with the 200-day moving average continuing to rise at this pace, it looks like we might have all three of these converge at a very key point there, right around 2,200. So it's going to be really important to see the NASDAQ index hold that 2,200 line in the sand, because that's likely going to mean staying trading above its 200-day moving average, staying above this level of support dating back to last year, and of course, reversing this current series of lower lows and lower highs that it's currently in. So by looking at these charts here, this should clearly show what the current attitude of the market is, that really is starting to put a lot of selling pressure on a lot of these tech-heavy indexes and tech stocks, certainly. But as I mentioned earlier, that doesn't mean that there's not opportunity out there to the upside for many other pockets of the markets. There's still indexes that are looking quite well. There's still sectors and pockets of stocks that are still continuing to perform very, very strongly. But it's just, it's a different basket of stocks than the ones that have worked very well over the past couple of years. And this is another chart right here, just really illustrating the tone of the market and the attitude it's taken this year. So, whereas last year the market was all in on the AI trade, all in on growth, all in on momentum, that has really sharply reversed this year. And what this is right here is a ratio chart, simply looking at the relative performance between the VTV Vanguard Value ETF and the VUG Vanguard Growth ETF. So simply, when you see this line sloping down over last year, what that is indicating is that the Vanguard Growth ETF was significantly outperforming relative to the Value ETF. So you can see that line sloping down for much of this past year. And this makes perfect sense because, of course, the growth trade last year was really trouncing the value trade, but that is sharply reversed this year. You see, really coming out of this low of relative performance in November of last year, you can see this line starting to slope up in a very, very sharp manner. It's done so over the past couple months. And what this is indicating is exactly what's going on underneath the surface of this market. It's this rotation out of momentum, out of mega cap tech. There's a lot of scrutiny around the AI trade, but all of this money and capital is flowing into other areas of the market, namely value plays out there. So this is why the VTV ETF has been outperforming relative to growth. So this is a really great illustration of just exactly how the market is picking winners this year. It's focusing more on the value areas of the market as opposed to the growth areas that have really driven a lot of the performance over the past couple of years. So this is a trend that our team's been watching very closely over the past couple of months. We noticed this right when this trend began to start kicking off late last year, and we started to see some of these other pockets of the market really begin to outperform some of the mega cap tech names out there. And so we started to pivot our focus as well to finding opportunities in these more value-oriented sections of the market. And this is exactly one of those opportunities right here. This is actually for Caterpillar. This is ticker CAT, and this is a stock right here that we spotted. Of course, it had a great performance through much of last year, really coming out of those April lows. The stock was performing very, very well. Very powerful series of higher highs and higher lows for much of last year, breaking out to new all-time highs. But we start to see the market really pivot to this value over growth preference. And it was right here in mid-November is actually when we sent out our first trade alert to the members of our weekly option alert trade alert service. And it was because, again, we had seen the strong price action from Caterpillar. We saw the stock have a big gap up here. We figured the trend was likely to continue on from there, but we were waiting for a bit better of an entry price, waiting for the stock to pull back, giving us a more favorable entry opportunity. That's exactly what we did. So right here around mid-November is when we spotted the opportunity for Caterpillar. We sent that trade alert out to our members, and shortly thereafter, you can see the stock reaccelerated higher, pushing up to a new series of all-time highs on several different occasions here. The stock actually became a little bit overbought and overheated in mid-December yet again. And so the stock pulled back. Our trade was actually structured so that, regardless of whether Caterpillar continued to trade higher, trade flat, or even sell off by a certain amount, the trade would be set up well for success. And that's exactly what happened. The trade alert ended up being a very nice profit opportunity for our members, but we still felt very strongly about the trend behind Caterpillar. We felt that this is exactly where we should be targeting our focus in the markets. And so we actually decided to roll this trade over in mid-November, right as the stock was pulling back off of those recent all-time highs. And so that's what we did. So we rolled the trade over in mid-November. You can see the stock continue to consolidate for a bit sideways through the end of the month there. But as the calendar turned over, you can see the stock actually begin to reaccelerate higher in a very notable way. In early part of January here, Caterpillar began to break out higher, pushing yet again to new all-time highs on a very consistent basis, a very strong series of higher highs and higher lows here. And so after this very strategic rollover, the trade again was still very well positioned. Should Caterpillar continue to trade higher, consolidate sideways, or even again sell off by a bit to the downside, but you can see just as we expected would happen, Caterpillar did reaccelerate higher, pushing up against those all-time highs, broke through them on numerous different occasions. And again, this month, that trend has continued as well. The stock is continuing to power higher. It's actually traded to above 780, actually just last week. And so this continues to be one of the stronger trends that we've spotted in the market. Now, the trade alert that we sent out to our members for Caterpillar, it's continuing to perform very, very well. And actually, as of market close on Tuesday, the trade alert that we sent out for Caterpillar to our members was sitting on an open profit opportunity of just about 77%. And of course, this has significantly outpaced the gains of any of the headline indexes over the past couple months. So we're continuing to watch this trend here for Caterpillar. It's one we still very, very much like. We think this trend has a very high likelihood of continuing to trade higher from here. It's really in the right pocket of the market. The industrials, the cyclicals, these are the areas of the market that are really starting to benefit from this market rotation. So we still really like the trade here with Caterpillar. It's one we're continuing to watch for our members. So I certainly hope that you watching this market update at home were able to follow along with that trade alert. But if you are not, that's totally okay because we are accepting new members into our weekly option alert program. So make sure to reach out because we'd love to see you join our trading team and see you inside of our Trade Alert service programs. Now, for the rest of the week, a few things that I'm keeping an eye on that could be market moving events. We do have one significant earnings report coming up later this week on Thursday. It's going to be from Walmart. They're actually reporting earnings. This stock has been on a very powerful trend higher. It's actually been one of the really bright spots amid this chop we've seen in the market. And so, the stock's rallied a lot into the earnings. That's always an interesting setup. So certainly waiting to see how the market's going to be reacting after Walmart puts out their earnings report and see what the price action in the stock is. So that's one key thing I'm watching for the rest of the week. And then on Friday, we actually get a really key inflation read. The PCE report, the most recent PCE report is going to be coming out. And this certainly is going to have an implication on what the Fed's next actions could be and also interest rates as well, which certainly could be driving stock price action as well. So a couple things for you to keep an eye on there for the rest of the week. But again, I hope you enjoyed watching this weekly market update. I really enjoyed the opportunity to be able to put it together for you. So thank you so much for tuning in. I hope you have a great rest of your week. And I'll see you back here in next week's market update. Until then, everybody, take care.